Can you see my screen?
Yes.
Okay. So today we are looking at audit planning. Um I think by next week we'll be done. It's just that yesterday was disturbed, but the plan was by Thursday we're supposed to do the major topics. So we've done three major topics, two actually. So there's risk assessment and professional ethics. Then there's also now tests for controls, then substantive testing. So, but before we get into tests for controls, I want us to first understand audit planning because it's important before you just, like we just get into a topic without really understanding the foundation, it tends to become a bit of a challenge. So I want us to first understand audit planning. Then now we're going to get into internal controls and test for controls. Then we're going to do the last one, substantive testing. Then we can say you're ready for the exam. It's just a matter of just practicing.
Okay.
Yeah, so let's begin with audit planning. Okay. So what is audit planning? So audit planning, this is just basically us, the auditors, before we begin the audit, we make a plan. We just assess how we're going to approach this particular audit that we're carrying out, right? So a plan allows the auditor to focus on the key essential areas of the audit. And also it allows us to just understand the client's business. Then we also have a feeling or a feel of how we're going to approach this particular audit. So the importance of audit planning is one, it allows the auditor to focus on key essential areas of the audit. Then two, uh, it allows for early detection of potential problems and finding solutions on a timely basis. Then three, it allows the auditor to approach the audit in an organized manner. Then four, important in selection of team members who possess the necessary skills and experience. Then the last point is it facilitates the direction, supervision, as well as review of the work. So let me just touch on the first point. So it allows the auditor to focus on the key essential areas. So this is what planning does. So when you plan, you prioritize. It allows you to prioritize. What are we going to focus on as we are carrying out this audit? And that's what planning does. Then two, whether errors or whether potential problems with the business, when we carry out risk assessment, we're able to analyze saying, okay, these are the potential problems that the client has, right? So it allows for early detection of those problems and where we can be able to find a response to those particular problems that we come across. Then the third point is it allows the auditor to approach the audit in an organized manner. So planning is very important. It allows you to set the steps and stages as well as the approach which you're going to use when carrying out the audit. So the auditor is more organized when they're implementing their work and carrying out their audit. Then the fourth point, it's important for selection of team members who possess the necessary skills. So if we carry out the risk assessment, then we see that this client is a high risk client. Then on the planning stage, we can be able to select those team members who have got the right experience and the right knowledge so they can be able to carry out this particular audit engagement in the most appropriate and the most effective and efficient way. Then the fourth point or the last point, which is the fifth point, to facilitate the direction, supervision, as well as the review of the work. So if we plan out, we can be able to know, okay, this is the approach we're going to use. These are the auditing techniques we're going to use. These are the substantive testing measures we're going to use. Then we're going to select different individuals who are going to supervise and who are going to also review the work of the different auditors that we're going to have. Then, okay, what's the structured approach to planning? So now, for us to carry out our audit engagement, we need to first plan and we need to follow a structured plan. So there are about four steps that we need to take. So one, we have to ensure that all ethical requirements are met, including independence. I remember you remember professional ethics. We have to make sure the
Yes.
auditor, yes, the auditor is independent of any influence, undue influence from the management or indeed those charged with governance. So we need to make sure step one, all ethical requirements are met. Step two, the terms of engagement, we have to ensure all the terms of engagement are also met, right? We need to understand, okay, what are the rules of the management with regards to auditing? What are the rules of the auditors? We also have to make sure the company or the client understands our duties as the auditor. They also understand our rights as the auditor. Whenever we request for information, we have to make them understand that we have got the right to obtain any information that we need from them. So we need to organize what are the terms of the engagement, what are the terms of the contract, what are the terms and conditions. So that's step two. Then to step three, audit strategy. So this is where we prepare the audit strategy. I remember last time we had auditing, I explained about the audit strategy. So the audit strategy is broad. So it outlines the scope, timing, as well as the direction of the audit. So just how broad is the audit, just how far, how complex is this particular audit, when are we going to carry out this particular audit? Does it correlate with our other audits, our timetable, because an audit firm, a large audit firm, is auditing different types of companies. So we need to understand, okay, does this particular audit, is it going to be carried out on a time that we're going to be free given our timetable with regards to auditing other companies. It also gives a direction of the audit. Okay, what approach are we going to take when we are auditing this particular client? And this is what we call the audit strategy. So the audit strategy sets the scope, the scope of the audit and the timing of the audit. When are we going to carry out the audit? Then the direction of the audit. What particular approach are we going to use when auditing this particular client? So the audit strategy sets the foundation, or it sets the tone for the audit plan. So the audit plan is more detailed than the strategy. So the strategy is broad. It just sets out the broad concept of the audit. So then the audit plan goes into detail. What is the nature of the client? When exactly are we going to carry out this particular audit, and how far are we going to take this audit? Are we going to carry out tests for controls, or are we going to carry out a full substantive testing? So an audit plan is more detailed. It goes deep into the books of the client. It goes deep into us carrying out this particular audit. So now let's look more on the audit strategy. So an audit strategy is one which outlines the scope, timing, and extent of the audit and sets the direction or foundation for a more detailed plan. As I outlined, an audit strategy is a broad view of that particular engagement, So when we're setting out the strategy, we don't really know um, the risks associated with that particular client. We're just brainstorming. We're thinking, okay, given this client and the industry, and given the understanding that we have, we're going to take this particular approach, and we're going to take this amount of time in order for us to finish the audit. Then after we set those projections, because we don't really know the extent of the risk that's associated with that particular client, right? We haven't yet done the risk assessment. So it's just us imagining and planning without really having the detailed information of how we're going to approach this particular audit. Then there are a few matters that we need to consider when we are setting the audit strategy. So one, we need to look at the characteristics of the engagement. Then two, we need to look at the objectives of the audit. Then three, we need to determine materiality. Then four, we need to carry out resource review. So the characteristics of the engagement, it calls for us understanding the client's business. So now, when we're setting the strategy, we need to have that broad understanding of the client's business. What business does the client engage in, right? Then we need to carry out that understanding. We just understand, saying, okay, maybe our client is Zambif. Okay. What business do they do? They are involved in retail trade. What exactly do they sell? They sell different perishable products, different meats, eggs, and all these other products. So we're trying to understand the client's business. Then two, the objectives of the audit. Okay, when the audit when will the audit be undertaken and how? What methods and procedures are going to be used? So that's the objective of the audit. When exactly is it going to be carried out, and what are the methods we're going to use in order to approach this particular audit? And again, it's just us imagining. We don't really know exactly the procedures that we're going to use because we haven't yet carried out a risk assessment. So we're just trying to project and think and assess and just imagine how we are going to carry out the audit, ceteris paribus, if all things are equal. Then also determine materiality. So materiality, we said a misstatement is material if it affects decision making of the users of those financial statements. So we need to determine the level of materiality. So we need to set a certain level, saying, okay, this particular level, if maybe sales revenue is maybe misstated by 5%, so if the misstatement is 5% of the particular revenue, so maybe the receipt that wasn't included in the books is 5% of the revenue, then we can say that's materiality, or you can say that's material to the financial statements. So we need to determine the level of level of materiality, which is going to allow us to assess and know, saying, okay, these financial statements, they materially misstated. So it calls for the principal areas that may result in risks of material misstatement. Before the client is audited, we just brainstorm and we just try to understand, saying, okay, what areas of the business can lead into material misstatements. Then we also need to carry out the resource review. Do we have the human resource? Do we have the finance? As well as do we have the time for us to undertake this particular audit? Any questions so far?
No questions.
Or contributions?
No, no, no. We can just proceed. No contributions.
Okay, so now let's look at the audit plan. So now, an audit plan is a detailed plan which uses the audit strategy as a foundation. As I've already outlined, a plan is more detailed. Now we've carried out the risk assessment. We've established the areas of the business which we think are going to be resulting into risks of material misstatement, right? So if we're auditing maybe um, just for argument's sake, a retail store, right? We've assessed maybe the till has got chances of being resulting in misstatements. Maybe that it's cash based, and we've seen that there are no proper controls relating to counting of money. There are no segregation of duties where the same person is the one that receives the money, the same person is the one that records the transaction in the register, the same person is the one that balances the books, the same person is the one that goes to the bank and deposits the money. So we've assessed, saying, okay, there's a risk of material misstatement at the till. So now we sit and plan and say, okay, how exactly are we going to approach this particular audit so that we can be able to obtain evidence that these financial statements, they're prepared in accordance with the applicable financial reporting framework. So now this plan outlines those details that are required for us to carry out the particular audit accordingly. So it sets out the nature, the timing, and the extent of the audit so that the auditor can carry out the audit procedures which limit the audit risk to a considerable level. So we've carried out our risk assessment, then we've established the risks, then we're saying, okay, how are we going to approach this particular audit? And we say, okay, for us to reduce the risk to a considerable level, we're going to take these and these and these approach. So we write down all those approaches, then we give them to the audit, I think, supervisors, then they go into the client's business, then they follow this plan to the latter. So now there are two audits which are carried out in one audit period, right? So this is very, very important. I've seen some questions about these two audits. So these two audits that are carried out in a year, they are one, interim audit. Then two, there's the final audit. So the interim audit is one which is carried out during the financial year. So all the financial year is still operating, right? So if maybe the client's business runs, client's financial year runs from January to December, right? Then interim audit is carried out within the year, maybe in June. We go and carry out some audit, or maybe in March we go and carry out the audit. Maybe September we go and carry out the audit, right? Or any month in between the month, that in between the year rather. So that's an interim audit. An interim audit is carried out within the financial reporting period. Then the final audit is carried out at the end of the financial period. So now the final audit, this is where now we're wrapping up, we're concluding the audit evidence that we obtained in the interim audit. Then we also have the audit evidence on the final audit. Then we are concluding, okay, what have we obtained? And given the information that we've obtained, what is our conclusion? What is our audit opinion? And that is done at the final audit. So the interim audit is carried out during the financial year, and the final audit is carried out during the final year, at the end of the operating, or rather the accounting period. So now let's look more into detail in the interim audit. So an interim audit is carried out during the financial year to obtain audit evidence that is relevant for risk assessment and detailed examination of the financial statements. So we go into the client's business, we carry out risk assessment. We look for instance, if our client is a warehouse, we go and observe the CCTV, we go and observe how the assets in the particular business, the inventory, how is it safeguarded? Are there locks in the particular warehouse? Who's the security guard? Is it the security guard who has the keys to the warehouse? So when we're carrying out those particular procedures, we're asking questions, we're inquiring from management how they manage their controls during the financial year. Then that's an interim audit. Then that information that we obtain is relevant for risk assessment, right? So when we take it to the head office, we can be able to plan how we're going to approach the audit. Then it also calls for detailed examination of the financial statement. So we go to the client's business, right? Maybe we attend an inventory count. I'm sure you have an inventory count at the end of the year, right?
Yes.
So now when the auditors are coming, they come during the year, right?
Yeah.
Yes. So that's called an interim audit. So an interim audit. So these are some of the points that you need to understand. Sometimes they can ask you what happens during an interim audit. Then you just need to respond to the examiner saying, one, risk assessment and gaining an understanding of the client's business, right? Two, recording of the client's internal controls. So we go into the client's business, we record the internal controls that that particular client has. Then three, evaluation of the design of those internal controls. So we record the internal controls, then we evaluate the internal controls, right? Then testing the internal controls. We go in the client's business, we test the internal controls, right? How do we test? We can test for, say, let me give an example of sales, right? We go into the client's business, maybe we get one invoice, then we follow it through the books. We ask, okay, this invoice, was it recorded? Yes. Where was it recorded? We check, okay, it was recorded on this and this day. Then we compare, we check the accuracy. If what's on the invoice and what was recorded in the books, in the finance, in the ledgers, if it's telling, we also check if there's an error. Then we also confirm the existence of those particular customers. Maybe we call the premises of the customer just to make sure that goods are being sold to an existing customer. Then that's what we do at the testing for internal controls. Then detailed substantive testing. Now this is where we go deep into the books, right? We go deep into the books. Sometimes we even go for um, the inventory count. We're checking the existence of the closing inventory in the statement of financial position. We attend the inventory count. Then we also check the assets that the particular company has. We ask, saying, okay, where are your assets? Want to see them? They say, okay, they physically exist. So all those things are done at the interim audit. So risk assessment and gaining an understanding of the client. Two, recording the client's internal controls. Then three, evaluation of the design of the internal controls, testing the internal controls. Then five, detailed substantive testing. I don't know if you have any questions or contributions. Hello?
I think just hello. Are you getting me?
Yes, I am.
Hello,
Yes, yes,
hello. Yeah,
yes.
yeah. So I'm saying that just a contribution. I remember when we are doing some audit, the
Mm-hmm.
auditor required like the stock and the asset count.
Mm-hmm.
Like they sampled some item from the asset register and they demanded that they see them physically where they are.
Oh yeah.
Yeah, so by then I didn't know to say it was an interim audit that they were doing because you are just working and the audit asks you where are these assets. So you just need to go and show them where they are. Some of them maybe they are damaged, but you just have to show them. So this is the asset which is
Oh
in the
yeah.
book. Yeah.
Oh yeah. 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 Yes. So that's that interim audit. Now they are confirming the existence of those particular assets. That's an assertion that we call um, existence. So the confirming the existence of those particular assets. All right. Thank you very much. All right. So now the final audit. So the final audit is carried out at the end of the financial year, so as to examine the financial statements for possible errors or material misstatements. So the final audit now, our focus is on the financial statements. We have obtained the evidence. We've tested the controls. We've carried out the substantive testing. Now we need to compare that particular information if it's tallying with the financial statements. So at the end of the year, the final audit, we do a substantive testing of the classes and balances and accounts in the financial statements and the amounts in the statement of profit or loss. So our aim here is to make sure all those um, transactions that are in the ledger, because when you prepare the ledgers, right, we need to prepare the trial balance. From the trial balance, that's when we go to the financial statements. So I have to make sure the information, the evidence that we obtained, those invoices that we tested for, maybe those receivables, right? We tested those receivables and those sales. We need to follow them through the financial reporting system, and we see how they reach the statement of financial position. Then if we check if there are any errors or not, then we also have to match the accounts, and we also we match the accounts and the accounts balances in the financial statements. So we have accounts in the financial statements, for instance, which are maybe inventory, right? We've got inventory. Then we tested some inventory. We observed some inventory. Maybe some inventory is damaged. You understand? Then we have to match it with the amount of inventory that's in the statement of financial position. So we have observed the physical inventory, right? Then we've checked that maybe some inventory is impaired. You have to now confirm by comparing with the financial statement of financial position, if at all uh, those assets which were impaired have been uh, included in the financial statements, or maybe there's a disclosure which was made saying, okay, we've got some assets which were impaired, or maybe they've recognized an impairment loss in the statement of profit or loss. This is what we do at the final audit. Then also carry out confirmation of accounts and balances in the financial statements from third parties. We've got receivables, right? We confirm saying, okay, does this customer really owes us? So we call the third party, we call the customer. Maybe um, we've sold we've sold cement to Consulting, right? Ngandu Consulting. And that's the only construction company that I know so far. So we call Ngandu Consulting. These they owe us. Okay. They owe our clients. So us as auditors, we get the contact from Ngandu Consulting. We call them. Okay, is it true that you owe our client such and such an amount of money? Then they were like, okay, yes, we do, we do owe them. Then we have to, then we confirm saying, okay, actually, the customer is real and the amount that's owed is real. If the customer refuses, say no, that's not the amount that we owe them less, then we know saying, okay, there's a misstatement. The amount that's recognized as receivables is overstated. Actually, the client, or rather the client's customer, owes the business less than what is recorded in the financial statements. Sometimes we also carry out what we call the confirmation of the accounts balances for cash, right? The cash that's in the statement of financial position, we write to the bank using their letterhead. They confirm saying, okay, yes, this is the amount that we have in the bank with respect to the customer's cash. And if the bank says no, we have less, maybe the amount that we have in the bank is not tallying with the amount that's in the statement of financial position, then we can be able to say, okay, the financial statements are misstated. Then we can carry out we can express an opinion saying, okay, given the evidence that we've gathered, the financial statements are misstated, they're not reliable, so the users must not rely on them. This is what we carry out at the final audit. Then we also obtain the written representations. So this is where management just says, okay, everything that we've given you, all the data that we've given you, all the information that we've given you is true according to our knowledge. That's what written representations are, and written representations are obtained at the final audit. Are we together?
Yes.
Okay, so now we also have what we call audit documentation. So audit documentation, these are basically documents which contain audit procedures performed, the evidence gathered, as well as the conclusions arrived at. So these are just documents where we keep our information. So it has got two types of files, right? You've got the current working papers as well as the permanent working papers. So the current working papers, they contain those files which are important to the continuing existence of the audit, right? They have continuing importance to the audit. So one, we've got engagement letters, the new client questionnaires. So this is just where we ask the questions to the client about their business so that we get an understanding of the particular client. So engagement letters, these are just uh, letters that are signed, or maybe these are contracts that are signed with the customer or the client saying, okay, let's get into an engagement. We're going to perform the contract in such and such a way. The current working papers, they are documents which are important to the current accounting period. So it includes the financial statements, the accounts checklists, as well as the management account detailed. So these are just for knowledge's sake. Uh, it's not really examined as much, but just for knowledge's sake, you can also take a look at this information. So now let's look
Okay.
at internal controls, right? Let's look at internal controls. So what are internal controls? Internal controls, they provide reasonable assurance that the objectives relating to the financial statements are being achieved, operations are efficient and effective, and that there's no and that there's compliance with rules and regulations. So internal controls system provides reasonable assurance that objectives relating to financial statements are being achieved, operations are efficient and effective, and that there's compliance with rules and regulations. So internal controls So an internal control system is just a system, you know, that management puts in place, right? There are certain activities that management puts in place to ensure that the objectives of the company are being achieved, and also ensure that the operations of that particular entity, they're efficient as well as effective, right? It also makes sure, okay, that all the employees in the business, they follow the rules and regulations that are governing that particular entity. So these controls, these are basically the activities, that the managers of the company, they put together, which employees are supposed to follow so that the company runs appropriately. So if these controls are absent, it means the company, it won't be as efficient. I don't know if you've worked for a small company before, but there are certain companies where you're an employee, but you're able to tell, saying, "Mm-mm, this company is going to fail very soon because there are no controls whatsoever, right? But the owner of
Yeah.
the business has no control whatsoever on how the business runs. Because I remember at some point I was working for a restaurant. This restaurant, the owner was a Zambian, he was an accountant, right? But
Mm.
how the business was managed was so pathetic, such that employees were stealing, like, so they would make pies. Like, we used to make meat pies, these shawarmas. So they, they never used to count the shawarmas that are made in a day. They never used to count the pies that are made in a day. So if you want, you're just hungry, you can get the pie and eat it. The owner can't know anything, right? So
Yeah.
trade kings would bring drinks. They would bring a lot of drinks, right? The drinks worth about 1,000, 2,000. They don't even count the drinks that come in. They just pack them, right? They pack them in the fridge. So, but when you're packing, you even drink one. Bah! The owner won't, won't even know. So those are pathetic controls. And now it means the operations of the business are not effective or efficient. Yeah. So, but for internal controls, if they're in place, it means the business is going to be well managed. It's going to be effective, and the employees are going to comply with the rules and regulations. So now, what are the components of the internal control system? So one, there's the control environment, right? There's two, there's risk assessment. Three, there's control activities. Then four, there's information and communication. Then five, there's communication. So one, control environment. So the control environment looks at the culture of compliance in the organization and the attitude of management and those charged with governance towards internal controls, right? It also looks at how much importance is placed on internal controls. So internal control environment just looks at the strategic level of controls. So what controls does management put in place? What's the culture of compliance in that particular organization? Do the employees follow the internal controls that are put into place? Do the employees respect the internal controls that the company has put into place? Right? Does management have that culture of forcing employees to respect these particular controls or not? What, how much importance, just how much do the employees value these internal controls? Because I'll tell you this, working for that company, we never had any controls. So we never respected the controls. There's no culture of controls. So they would bring drinks, they'll bring mashani, my happy apple, when you just taste this, you drink. We never even had any respect for the controls because there were no set of controls that were put in place. So now, as an auditor, when you're auditing a company and we're auditing the control environment, so one, we need to look at management's emphasis on creating a culture of communication and enforcement of ethical values. So just management, how much emphasis do they put on the employees to act ethical? Just how much emphasis does the management put in place? So also have to check if there's a system, if there's a strong system of internal controls which creates the foundation for other items of the control. system. We need to observe, saying, okay, is there a strong system of controls? Are the tasks and jobs of the employees well structured? If yes, then the control system is strong. If not, then the control systems are weak. Then also look at the participation of those charged with governance. The board of directors, are they enforcing the internal controls on these particular employees? Is there an internal control or an internal audit function, right? Is there a risk assessment committee? So all these are the things that we need to look at when we're carrying out an audit of the control environment. Then two, risk assessment. So risk assessment involves identification, classification, as well as response to risks which may have a direct impact on the financial statements, right? So does the management through the risk assessment um, function, are they able to identify as well as classify those risks? So sometimes you might, so if a business, a large corporation, for example, we've got the internal audit function. The internal audit function test the controls before the external auditors come. They test the controls. They check, are the control systems that we've put in place functioning accordingly? Are the employees respecting the systems of controls, right? Then they observe for those risks that may result in material misstatement. Maybe a risk is that we've employed someone who's not very knowledgeable as an accountant, right? So due to nepotism, you employ a person who studied nursing to work as an accountant. So now the internal audit function, if it has got a strong system of controls, you'll be able to assess saying, no, our problem is with our HR. How are they employing a nurse to come and work as an accountant? So now we need to rectify that error by making sure we've got a strong system for recruitment as well as employment as well as training of employees, right? So now, what does the auditor do with respect to risk assessment? So the auditor needs to check if the system has, if the client has got a system of identification of risks. One, if the company has got a system of estimating if the risk has a significant impact on the entity. Then three, if the client has got a system of assessing the likelihood of the risk occurring. Then five, um, if the client has got a system for deciding responsive action. I'll give the example again where does the internal audit function or just the company in general identify the risk, saying, okay, we've employed a nurse to work as an accountant. Are they able to identify that risk that maybe that accountant won't be able to know the double entry for a sale? So it means a company receives a sale, they can end up debiting the purchaser's account because they don't have the knowledge in accounting. So can they estimate the risk, uh, how much that risk has got an impact on the entity? Can they estimate the likelihood of the risk occurring? No? Can they estimate or rather, can they decide the responsive action that they need to take in order for them to rectify that particular risk that they observe in the company? I don't know if you have any questions so far. Hello?
No questions.
Okay.
Hello?
Yeah, I can get
Yeah.
you. Okay. So now the third component is the information systems and communication relevant for financial reporting. So basically, this includes financial reporting system which initiate, record, and process and report transactions, right? It also involves maintenance of accountability for the entity's assets, liabilities, as well as equity, right? So the information system, how is information, or rather, how do transaction move from the ledgers to the financial statements, right? How are transactions initiated? How are they recorded? How are they processed? As well as how are they reported? Now, how does the company maintain its accountability for the entity's assets? How do they know that these assets they are safe? How do they know that we have a liability that we need to offset? How do they just maintain that accountability for equity? So this is what the information systems and communication looks at. It's just the communication in the organization, right? Just how does information move about in the organization? How is information taken care of? How is accountability for assets and liability and equity taken care of? It's just about how information moves in the organization. How is the management informed about the systems and processes that are found in a particular business? Just how do we keep our records, or rather, how does the client keep their records in this particular business? So now the auditor must look at the transactions relevant for financial reporting purposes. So now we test the transactions. So which transactions, or how does the particular client record these transactions? How do they move from, for example, a sale from the point of sale into the books, and from the books into the financial statements? So also need to assess the procedures which initiate, record, process, as well as report these transactions. We just need to understand how is a sale initiated, and after it's initiated, how is it captured in the books, right? If it's captured at first, uh, in which books are they information captured? Do they use Excel? Do they use QuickBooks? Are they using Pastel? And how do they process these particular transactions? And how are they finally reported in the financial statements? So this is what the auditor needs to have an understanding of. So we also need to understand the accounts, the registers, and other information, and specific accounts in the financial statements which are used to initiate, record, process, as well as report the transactions. So now, what are the clients' registers? Do they have an asset register? Right. So all these information is that what we're trying to understand as an auditor when we are assessing the information systems and communications which are relevant for financial reporting purposes. Then now, the fourth component of an internal control system is the control activities. So basically, the control activities, that they are the actual control activities, the actual activities that the customer needs, or rather, that the employee needs to carry out, right? So these are the actual activities. So if, for an example of a control activity is where we say uh, a retail store, right? We sell, it's a restaurant. We can put in place a control saying that particular individual, the cashier that receives the money, they are not supposed to be the ones that take the money to the bank. We can say another individual who maybe is the treasurer needs to come together, needs to come and balance the books together with that particular cashier. That individual who balances the books is the one that takes the money to the bank. So there's a control which is segregation of duties, and it's going to prevent chances of fraud. It's going to reduce the fraud risk factors. So that's a control, and that's a control activity. Another example is where we say, okay, at the end of the year, when we're counting inventory, we need at least two people who are counting the inventory. There's one who's counting, then the other one is counter checking, or one is counting, then the other one is recording the amount of inventory that's in place, right? And that's a control activity which is going to reduce the amount of errors. I don't know, how do you carry out your inventory count?
So we have the people that we call stock takers.
Uh-huh.
Yes, so we do quarterly. So they
Mm-hmm.
count the stock monthly,
Mm-hmm.
but us we also just go through just to verify whatever they have counted. But mostly we don't do the actual count, but we'll be there. We'll get some independent people to count just to verify what those guys have counted. So we won't count every product because we have a lot of products. There are more than 1,000.
Mm-hmm.
So just sample out some few products and we count those. If those have got issues, then we sample more. But if
Mm-hmm.
those have got less issues, we depend on those to say everything is correct now.
Okay. So now what you do there is that's a control where one group of individuals they carry out the count, then you come and verify. That's
Yeah.
a control activity. Yeah. So now, so control activities, these are systems and procedures which ensure the instructions. Just a minute.
Okay.
Okay, yes. So these are systems and procedures which ensure that the instructions of management are effectively carried out. So the instruction that you give to those stock takers is for them to count the inventory accurately. So there are chances that they're also humans. They can make mistakes. So by putting in place a control which verifies the amount of inventory that has been counted, we are going to reduce the amount of error with regards to the number of inventory or the amount of inventory that has been counted, right? So those are control activities. So control activities, these are procedures and systems which ensure that instructions of management are effectively carried out. So the auditor must check whether the controls which prevent, detect, as well as control material misstatements are in place. So now, us as auditors, we come to your company. We need to ask or inquire from management, is there a system of confirmation of counts, right? Do you confirm the counts? How do you confirm the counts? Then what you've explained is what you're supposed to explain to the auditor, saying, oh, yes, we do have a system of confirming the counts, but since we have a lot of inventory, what we do is we sample. And after we sample, then if we feel there are some errors, then we have to increase our sample size. So when you do that, then auditor is going to have an idea saying, okay, our company or our client has got a strong system of controls, right? Then also we also need to look at authorization, ensuring that all actions and decisions are authorized by a senior, right? Inventory has been sold. Maybe Avic International has bought or maybe 1,000 bags of cement. Are those 1,000 bags? Do those 1,000 bags of cement just go out of the business without any authorization from a senior, right? So if there's an authorization from a senior, then that's a control activity. It's preventing exorbitant amounts of inventory from going out of the company. So sometimes, what employees are a bit sketchy, yeah? So maybe Avic can order 900 bags of uh 900 bags of cement. Then we write an invoice for 1,000. Then the 100 bags, they are ours. Avic, they are ours. Then Avic pays for 1,000 bags instead of paying for 900. They pay for 9,000, which they haven't bought. But if there's a system of authorizing the sales, so we're selling 1,000 bags. Then a senior authorizes saying, okay, wait, these are inventory that are going out. Okay. The senior authorizes, then there's a system of saying, okay, maybe there are a few chances of fraud. I don't know if there's authorization of some sort in your company.
Yes, we have.
Yes. So now that's a control activity. Then also passwords on computers. So if the computers, we put in place passwords so that we can reduce the amount of people who are accessing our data. Then also segregation of duties. where one person who receives the money from the customer is not the same person who writes the invoice, is not the same person who records the transaction, is not the same person who authorizes, then there might be a chance of fraud. If the same person is issuing the invoice, the same person is receiving the payment, the same person is authorizing inventory to go out of the business, then it's going to be easy for them to steal. They can create a fake invoice. After they create a fake invoice, then they also authorize the inventory, and when they receive money, they just remove the amount of their money, and the rest they pay to the business. So we have to make sure we check if there are segregation of duties in that particular client. Then lastly, monitoring activities. So monitoring activities, these are processes and procedures put in place to make sure that controls are functioning effectively and taking
Yeah.
corrective action where deficiencies have been observed. So we have to make sure, does management monitor the activities in the business? These control activities, does management monitor them? Right? So the auditor must check for existence of these monitoring activities. We have to just check if at all the management or those charged with government, they monitor these particular uh, activities, which are control activities. Any questions or contributions?
Just a contribution on just the previous one, segregation of duties.
Yes.
Yeah, so there's a situation that happened at work.
Uh-huh.
Yes. Because me, I'm in accounts and I'm the supervisor there.
Mm-hmm.
And we have receivables.
Yes.
Yeah, so these receivables, they need to pay money after 30 days.
Uh-huh.
But it passed 6 months. They used to come and pay. They used to come and pay cash
Uh-huh.
to the office.
Uh-huh.
A lot of money they would come maybe with 150,000 cash they pay.
Mm-hmm.
Sometimes I even used to tell them to say, why can't you just transfer? There's no need for you to be walking around with such a lot of cash coming
Uh-huh.
to the office. But they just kept on doing that. So
Mm-hmm.
now their debt was a lot. It was about almost 900,000 there.
Mm-hmm.
So they remained with about 300,000.
Mm-hmm.
So after we engaged them to pay, to push them, we even engaged an external debt corrector
Mm-hmm.
just to push them. Do you know what they started saying?
Mm-hmm.
But we've already paid. They told the external debt corrector to say, we've already paid those monies.
Mm-hmm.
Uh, then Isaac, they know. They
Okay.
know what happened. So they wanted like to entice me, like to bring me into that issue.
Oh.
Now the good part, yes, the good part there is a segregation of duties. So me, I only post transaction, I don't receive cash.
Oh yeah, yeah,
So
yeah.
what happened yeah. So what happened? We had to ask them to show us receipts
Mm-hmm.
where if they are claiming that they paid. So we ask them, say, okay, show us the receipts where you paid and who did you pay to. Just
Mm-hmm.
say the name of the person you paid to and the receipt they issued to you. So it was discovered that they were shocked to discover that us we don't even receive the money. We
Oh.
just according to what we have on the bank statement.
Oh
So
yeah.
even if you go cash to our office, we are not going to post a payment on your account. We'll wait for that money to be deposited in the bank, and we'll use the amount in the bank to post on your statement.
Oh yeah.
Yeah. So when you explained that control for segregation of duties, that now imagine if I was the one to do everything,
Oh
collect
yeah.
the money, go and deposit it, go and deposit in the customer account, I would have entangled myself in those issues.
Oh yeah.
But right now, I was saved because of segregation of duties.
Oh yeah. Wonderful. So
Yeah,
your company has got a strong system of controls, eh?
our company, yeah, we are improving every time when there's a mistake, so they work on that and establish some
So
controls.
now this is where we say risk assessment. So they're able to identify and classify as well as respond to those particular risks which they discover, which is very good.
Yeah.
Yeah. So now let's look at limitation of controls. What are the limitation of controls? So one, the cost of setting up controls may exceed their benefits, right? So look at the segregation of duties. So for you to segregate duties, you need two different people or three different people who are paid a salary each. So that can be costly, and maybe the cost may exceed the benefit. Then two, employees may create collusion to commit fraud. So this happens where the person that's receiving the payment and the person who's posting the transactions, right? They collude saying,
Yeah.
okay, I've posted this particular amount. Uh, it's fake, but I want you I've deposited this particular money. It's fake, but I want you to make sure you post the same amount. So maybe the customer paid an amount of maybe 10,000, but the actual amount owed is maybe 8,000, right? So the two people, the one who receives as well as the one who posts, they collude saying, okay, the actual amount is 8,000, so post 8,000 instead of 10,000. So then we'll share that 2,000. That's on top. So that's collusion. So two employees, they can collude to commit fraud, and this can be detected by the internal controls. Then management may override the controls. So a senior management, the senior finance manager can steal. They steal money from the bank. Maybe they put it in their account. They for 3 months they buy treasury bills so that they can earn some discount. But they tell you the person who's posting saying, okay, this amount is going into this particular account for 3 months, but this is a customer that this is a supplier that we're paying to. Then they tell you saying, no, make this payment. And that's your senior. You can't refuse, you know?
Yes.
Yes, that's management overriding controls. And the system can't detect those errors. Then human errors, well, we are humans, we can make mistakes. Maybe you're tired, you never slept the other day, maybe you've got an HO, you were, drinking the whole weekend, you come for work, instead of posting 1,000 amount that's owed, you post 10,000, you know. So that's human error, which can't be really uh, detected by internal controls. Then they may not be useful for non-routine activities. There are certain activities which don't happen frequently, because there are certain activities which happen after a certain period of time. So those non-routine activities, they are also not captured by internal controls. I don't know if I have any question or contribution.
No questions.
Okay. So now, there are methods of accounting, or rather there are methods of recording accounting controls. So we as the auditors were carrying out this interim audit, we need to go and record the internal controls that the particular client has. All right. So how do we record these particular controls? So we've got one using flowcharts, then we've got two using questionnaires, then we've got three narrative notes. So this part that we're carrying, what we are looking at, these are those maybe 3 marks, 2 marks, sometimes 5 marks, which they can ask you in the exam. So you have to make sure at least you know a bit of these flowcharts, questionnaires, as well as narrative notes. So one flowchart, I'm sure you know what a flowchart. This is where we just go into the business. We create a flowchart of how the controls are arranged in that particular client, right? So what are the advantages of a flowchart? So one, they may be prepared quickly once some experience is gained. So if the auditors who we have engaged to carry out the audit, they gain some experience, they can be able to quickly prepare these flowcharts. And two, they are easy to follow rather. They are easy to follow and review because they are prepared in a standard form. So flowcharts are prepared in a standard form. So you're able to explain saying the system of sales is this. So when this happens, what our clients employees do is this. After this is done, what is done is this. If this is not done, then the client does that. So it's more standardized, right? Then it ensures that the entire system is documented, hence loose ends are captured. So it ensures like majority of the systems are captured, even though everything can be captured, but at least majority of the system is captured. Then disadvantages, auditors may require training, which may be costly. So me as an audit trainee, I'm a new employee, I may not know how to use these flow charts. So they need to carry out some training. And for me to get trained, I need to at least get paid for attending a training or a seminar or a workshop. And those who are training as well, uh, they need to be paid. So it's a bit costly. Then two, it may become time consuming if areas of non-audits significance are charted. So a large, or rather the entire system is documented, right? But there's certain areas which are not really relevant. And if those areas are charted, then it's just going to waste time because they won't be useful at the end of the day. Then major amendments may need redrawing of the flowchart. So sometimes you may need to change certain parts of the flowchart. Then means the whole flowchart needs to be changed. And those are some of the advantages. So two internal controls questionnaires. So internal controls questionnaires, they ask the question, how good are the controls? So if we come and audit the client, just how good are the controls? So we just ask the client, do you have these controls? Then we write down. Are these controls present? We write down. You know, what are the controls for maybe fraud so that money is not stolen? Then we write down. Do you have segregation of duties? You write down. So that those are the internal controls questionnaire. So we just ask what internal controls are present in that particular client's business. So the advantages are one, all controls may be captured if drafted thoroughly. So if we draft thoroughly, if we ask as many questions about the controls as possible, we can be able to capture all the controls. They are easy to prepare. You're just asking questions, right? It's just the questions that we're asking. So there's no training that you need in order for you to carry out this job. So it means they're even more cheaper than the flowcharts. So they're easy to use as well as controls. Then disadvantages, the key controls may be omitted if drafted vaguely. So sometimes sometimes the people that we employ can be lazy. Instead of asking the questions as they are supposed to, then maybe they're tired, they start skipping questions. I remember this is what we do when we're carrying out research. This is just a commercial break. But so when we're carrying out research, sometimes you get tired, You've been in the field for like 2 weeks, 3 weeks, then you get tired. So sometimes instead of asking questions, you start answering for the respondent.
Yeah.
You answer for them, because you're tired, So now those are some of the disadvantages because the key areas of the research they are omitted. You answer for them. So this is something I'm relating it to. So the key controls may be omitted if drafted vaguely. Then they contain a large number of irrelevant controls. So these are just a few things that you need to study and memorize so that in case you are asked in the exam, you can be able to answer. Then internal
Okay.
control evaluation questionnaires, they focus on what type of errors may occur rather than if specific controls are present. So I just ask, okay, can this error occur? So if we're able to ask, can this error occur? Then the client answers, no, because we've got a system of controls which are A, B, C, D, E, F, G. And those are internal controls questionnaires. So advantages, they may be used in different systems, then they may detect deficiencies where a full substantive test is required, then the disadvantages, they may give an impression that all controls are equal weight, but which is not the case, and the client may overstate their controls. So asking them, can this particular error occur? Then for them to make it seem like their business is working well, they can inflate the functions of their controls. With that said, I think this is the last slide. We are done.
Okay.
Yeah. So I don't know if you have any questions so far.
No questions.
Contributions.
No contribution, but I just need to study them now and try to attempt some questions.
Yeah. So you should, because
Yeah.
this is, yeah, it's an interesting
Okay.
topic.